There are a lot of people online pumping Apple as the next great investment. But is it really worth your hard-earned money to invest in this company right now? In this video, we'll look at both sides of the coin, the pros and the cons of investing in Apple today. And at the end, I'll give you my honest opinion about whether or not I think Apple is really a buy or if you should just leave it to die. Hey folks, thanks for tuning in. First things first, I am not a financial advisor, and this video is for your educational and informational purposes only. Today we'll analyze Apple. Let's get right to it. So, how does Apple generate revenue? Apple is a type of company that's known for selling some pretty amazing products. It's best known, however, for its line of smartphones, which are top notch in terms of design. The iPhone dominates the global smartphone market, with Apple controlling 18% of the market share as recently as Q1 of 2022. The company also has a love affair with consumers since it constantly thinks of new ways to keep them interested and ultimately sold on their products, while including features that appeal to a wide number of demographics. This level of brand loyalty provides Apple with a wide brand moat as loyal customers faithfully and repeatedly purchase their products. But it's Apple's service business that offers the most potential for revenue growth. With Apple's products already controlling a majority of the market share in this technology segment, it will be difficult to gain more market share. However, Apple's current strategy is to accelerate the growth of its services product lines, which have higher margins and predictable recurring revenues from services such as iCloud, Apple Music, and Apple TV. Regardless, Apple is always looking to the future and building more advanced technologies within each device they make so that they can continue to stay ahead of their competitors in today's modern marketplace and continue to generate new revenue opportunities. So, what are the pros of buying Apple today? The first reason you might want to consider buying Apple is if Warren Buffett is your guru, then what Buffett loves, you might love too. Just as famed investor Warren Buffett enjoys a cherry Coke, he also seems to have an indestructible penchant for tech giant Apple. Apple is currently Warren Buffett's largest investment. As of the end of Q1, Apple shares accounted for 42% of Berkshire Hathaway's portfolio. The figure is astonishing, considering that Apple's stock wasn't looking so great lately, down almost 30% since January of 2022. You would be buying one of the best businesses in the history of investing. The ever-popular Apple is set to usher in an even brighter future as its fantastic balance sheet and overarching fundamental growth prospects point to better investment potential. The company generated $102 billion in net income over the past year. Apple has consistently grown its TTM earnings per share, leading some shareholders to take a bet on the stock while its price appears cheap compared to where it was around January. New products and services support Apple's long-term growth thesis. Apple continues to be a leading, innovative technology company, continually reinventing itself with new and updated products. This innovation should continue to strengthen the revenue growth of its service products, as the majority of Apple's customers are loyal to the brand. Upcoming products include new and improved MacBook Air and Pro models. And rumor has it that Apple is working hard to develop an Apple Car for release sometime after 2024. Could this be a Tesla killer? But the innovation doesn't stop there. Apple announced Apple Pay Later, a buy now, pay later product that will enable users to split the cost of their purchases into interest free payments with 4 installments. That's all well and good, but what are the reasons to avoid buying Apple at this level? Government regulations could dissolve Apple's very profitable App Store fees. Back in October of 2020, Apple warned investors that the huge fees they make from App Store purchases, such as apps and in app purchases, could be drastically reduced by government regulators. Currently, app developers are paying a 30% commission on in app purchases. A regulatory slashing of this commission structure could lower expectations for the high growth services revenue Apple's management team is currently focused on. And any negative growth in the services division will cause Wall Street pros to value Apple at lower multiples. Stocks are in a bear market. It's a well known fact that 75% of stocks move in tandem with the general market. To make matters worse, inflation is a major contributor to this bear market. When inflation runs hot, the Federal Reserve raises interest rates. If you've followed me at all, you already know that rising interest rates negatively affect stock valuation multiples. And if this is news to you, I'll add a link in the right corner to another video of mine that explains it in detail. Apple isn't immune to this phenomenon, so its stock performance is likely to be impacted if the bear market in stocks continues. Consumers have less disposable income. Everyone has seen the economy's downward spiral, and those at the bottom of the financial ladder are often those rushing to make ends meet by cutting back on unnecessary expenses. This often means that families allocate any extra cash they have towards necessary products such as food, shelter, and fuel, which leaves them with little money to spend on other things. Should consumers' purchasing power continue to decline, Apple's earnings may be impacted. With the pros and cons out of the way, let's move on to valuation. Apple's share price is down almost 30% year to date, leading many investors to believe the stock is cheap. If I look at Apple's average price to earnings multiple over the last 5, 10, and 15 years, I get average multiples of 24.86, 23.14, and 23.27. Currently, Apple's price to earnings multiple is 22.34, and the forward price to earnings multiple is 20.98. So, based on the PE multiple, Apple appears moderately undervalued. But if we compare the historical 5, 10, and 15-year price to sales multiple, I get averages of 5.75, 5.34, and 5.16, with the current price to sales multiple at 5.62. Apple appears fairly valued. So, what do I personally think of Apple here? I believe Apple is a great long term investment at the right price. Apple's wide economic moat and growth prospects are attractive. But on a macro level, we've got a lot of big economic problems right now. Inflation and rising interest rates are causing a great revaluation of most stock investments. Consumers have less discretionary cash to spend. Stocks are in a bear market. Until these economic issues are resolved, Apple could be valued significantly lower by investors than what we see in its current multiples. So, for me, Apple is another stock on my watch list. For me to begin dollar cost averaging into this name, I would need to see it trade at a significantly lower valuation. And for me to be an aggressive buyer of this name, I would need to see the global macroeconomic picture take a positive turn. Thanks so much for watching. Let us know in the comments below what you thought of the video and any suggestions as to what you'd like me to cover in my next buy or die video. Plus, if you want to access my best market analysis, trade ideas, model portfolios, or free stock market e-learning course, please register for our upcoming membership launch at conquerwallstreet.com.